DexCom just did something that sounds almost impossible for a company most people think of as just a glucose monitor maker. Its earnings per share grew by over 75% in the last 12 months. And yet, if you only glanced at the stock's valuation, you might think this company is priced like a sleepy, slow grower. So which one is it? A hidden growth machine or an overpriced medical device stock? Let's dig into the numbers and figure out what's actually going on here. Let's start with the top line because this is where the story begins. Over the last 12 months, DexCom brought in $4.97 billion in revenue. That's not just a big number for the sake of being big. It grew 15.54% compared to the year before. To put that in perspective, most large established companies are thrilled with mid-single-digit growth. DexCom is growing at double that pace, and it's been doing this consistently for years. Back in 2021, revenue was $2.449 billion. Today, it's essentially doubled. That's not a one-time spike. That's a company that keeps finding ways to sell more. But here's where things get interesting. Growing revenue is one thing. Actually, turning that revenue into real profit is a completely different challenge. And this is where a lot of companies fall apart. DexCom didn't. Out of that $4.97 billion in revenue, the company kept $999.70 million as net income. That's a profit margin of just over 20%, meaning for every dollar that walks in the door, DexCom keeps about 20 cents after all expenses, taxes, and costs are paid. And if you look even earlier in the process, the gross margin, meaning how much money is left after just the cost of making the product, sits at 62.47%. In simple terms, DexCom is not just selling a lot of devices, it's selling them at very healthy prices compared to what it costs to make them. Now, at first glance, that sounds impressive, but a smart investor doesn't stop at margins. They ask, is management actually using this money well? And this is where DexCom quietly reveals one of its most underrated strengths. Return on equity sits at 38.49%, and return on invested capital is even higher at 44.49%. To understand why that matters, compare it to something called WACC, the weighted average cost of capital, which for DexCom is 11.55%. Think of WACC as the cost of the money the company uses to grow, whether from investors or debt. When a company earns 44.49% on capital that only costs 11.55% to raise, that's not just profitable. That's a business model that creates real value every single year it operates. This is the kind of number that professional investors get excited about, and casual investors usually never even look at. And that's not even the most surprising part. Let's talk about the balance sheet, the financial health report of the company. DexCom holds $1.95 billion in cash, while carrying $1.40 billion in debt. Subtract one from the other, and you get a net cash position of $548.60 million. This is a company that, if it wanted to, could pay off all of its debt and still have over $500 million left over. Its current ratio is 1.73, meaning it has $1.73 in short-term assets for every $1 of short-term liabilities, a sign it can comfortably cover its near-term bills. And interest coverage sits at a staggering 75.94, which basically means the company earns 75 times more than what it needs just to pay the interest on its debt. This is where investors often get confused, assuming a growth company must be loaded with risky debt. DexCom's numbers tell a very different story, but no company is perfect. And this is where we need to shift from strengths to something that deserves a closer look. DexCom does not pay a dividend. For income-focused investors, that's an immediate red flag. However, the company isn't ignoring shareholders completely. It has a buyback yield of 2.61%, meaning it's been repurchasing its own shares. In fact, the number of shares outstanding has decreased by 2.61% over the past year. Fewer shares outstanding means each remaining share represents a slightly bigger slice of the company. That's one reason earnings per share can grow even faster than net income itself. Now here's a number that might really catch you off guard. Institutional ownership is listed at 101.21%. That's right, over 100%. At first, that might sound like an error, but in the world of stock ownership data, this can happen due to how shares are counted across lending, funds, and reporting overlaps. What it does tell us clearly, though, is that large institutions, pension funds, mutual funds, hedge funds, are heavily involved in this stock. Meanwhile, insiders, meaning executives and company leadership own just 0.25% of the company. That's a very small personal stake for the people running the business, and it's the kind of detail that's easy to miss if you're only looking at revenue and profit. Let's talk about valuation now, because this is usually where the debate really heats up. DexCom trades at a trailing price-to-earnings ratio of 34.42 and a forward price-to-earnings ratio of 31.02. In plain English, investors are currently willing to pay about $34 for every $1 of the company's past earnings. Is that expensive? On the surface, yes, compared to slower-growing companies. But here's the twist. The P/E ratio, which compares the price-to-earnings ratio to the company's growth rate, sits at 1.45. A PEG ratio closer to 1 is often viewed as more reasonably priced relative to growth, and 1.45 suggests the stock isn't wildly disconnected from its growth story, even if it isn't cheap either. And just when you think you've got the full picture, here's another twist. The stock's Relative Strength Index, or RSI, is sitting at 72.64. Without getting too technical, RSI is a tool traders use to measure momentum, and anything above 70 is often considered a sign that a stock may be overbought in the short term, meaning it's had a strong run recently. Combine that with a beta of 1, which tells us this stock tends to move about 41% more than the overall market in either direction, and you get a picture of a stock that can move fast, both up and down. So how confident are the professionals watching this company? 28 analysts currently cover DexCom, and their average price target sits at $93.44, about 7.02% above the current share price. Their consensus rating is strong buy. They're also forecasting revenue growth of 11.49% and earnings growth of 21.15% over the next 3 years. That's a meaningful vote of confidence from people who study this company for a living, though, of course, forecasts are estimates, not guarantees. Before we wrap up, there are 2 more numbers worth knowing, because they tell us how safe this business is from a pure survival standpoint. The Altman Z-score, a formula used to estimate bankruptcy risk, sits at 6. A very strong score, far above the level typically associated with financial distress. And the Piotrowski F-score, a 9-point scale measuring overall financial strength, comes in at 7. Together, these 2 numbers suggest a company that isn't just growing, it's doing so on solid financial footing. So where does that leave us? On one side, you have a company with accelerating revenue, expanding profits, extremely high returns on capital, a strong balance sheet, and enough cash to comfortably manage its debt. On the other side, you have a stock trading at a premium valuation, showing signs of short-term overbought momentum, very low insider ownership, and no dividend for those seeking income. Both of these stories are true at the same time, and that's exactly why this stock generates so much debate. The real question isn't just what these numbers say today, it's what they'll say a year from now. Will DexCom's growth continue to justify its premium price tag, or will the market eventually demand a reality check? That's something only time and the next set of earnings reports will answer.